This conference will now be recorded.
Good morning, everybody. And I think it's not too late to say Happy New Year, since this is our first full board meeting of January 2023. The agenda is pretty straightforward, and we have had some of our budget subcommittees meeting on some of these things, so they'll be, restating for the full board. But let's get started. I'm going to call this meeting to order, January 20th, 2023 at 9:03 a.m. Okay, let's ask first for public comments. Do we have any? Okay, hearing none. Yes.
Sorry, this is Brian. I wanted to see if I could request a revision to the agenda to move agenda item 6, which is financing programs, to follow agenda item 3, which is the consent agenda. We've got some staff who need to get to some health-related matters.
Absolutely. So does anybody want to make a motion to do that?
This is Benoit, still moved.
This is
Okay,
Matt.
and
Second.
Matt? Oh, great. Thank you. All in favor?
Aye.
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 Okay, good. All right. So the number 3 agenda item is the consent agenda. And Brian, did you want to talk a little bit about that, or should I go ahead and ask for a motion? I mean, it's something that we've already addressed as a subcommittee, but go ahead.
Yeah, why don't we move the motion? I think everyone's pretty aware and in tune with these items. So yeah, happy to move the motion unless folks want me to go into detail.
So moved. John Harity.
Do we hear a second?
Second, Matt.
Thanks, Matt. Okay, all in favor?
Aye.
Aye. Aye.
Yes. Okay, opposed? Abstaining? Okay. Moving forward. So the next item now will be item number 6. Is that Mackie?
That's correct.
I'll get us started, yeah.
Okay.
Thank you, Chair Reed, and thank you everyone for letting us jump the line here this morning. We've got 2 financing programs items, 2 pretty exciting changes and new products we want to talk through. First, I want to talk through another change to our ever-evolving CPACE program. I think as everyone's aware, CPACE is really our premier commercial financing product. Was put in place just over 10 years ago, and it's significantly evolved over time as we've learned from implementation, as well as trying to keep up with changing and evolving energy policy goals of the state. So in that vein, we've been looking towards the state electrification goals and thinking through how we can make sure that CPACE is a tool to help the state meet those. So I wanted to talk through today with a pretty significant potential change to the program that we think would further enable it to be a tool towards meeting that goal. This would require first a statutory change and then a program guidelines change, and then the public comment on the program guidelines. So, it'd be quite a process, but we didn't even want to start taking steps towards that process before having this conversation with you all to make sure that it was something that you were comfortable with, and also get your input to shape it to make sure that you saw it as achieving the goal that we were looking for. So I want to turn it over to Elise Buzelli, who's really been the leader on this effort.
Some feedback there. Hey, everybody. Good morning. So thanks, Mackie, for setting that up. This is something we've been working on in a couple of different iterations for a while, but this is the one that we've landed on. So looking forward to the discussion today. So what you're seeing on the screen here, this is just the quick little blurb from the current statute that explains the savings to investment ratio. And I put the little calculation down there for everybody. So essentially what we ask the contractor or the developer to do on the project is do an audit or a feasibility study of the energy project and calculate what the dollar savings for that project will be over the life of the equipment that they're installing. So we take that dollar number and we put that in the numerator in the savings, and then we divide that by the investment, which in this case would be whatever they're looking to finance with us, which is typically the entire project cost, as well as the closing fees and any interest that they'll be accruing over the term of the loan. And we want that to be greater than 1. So essentially, we want to have a positive cash flow situation over the useful life of the improvements. So that's kind of the basics of the SIR. And then the issues that we've been seeing here, I'm going to kind of kick this off, and then I'm going to turn it over to my colleague Vijay Gopalakrishnan, who's on the line as well. Vijay works for our CPACE Technical Administration company, DNV, and he was very integral in helping me craft some of this. But essentially, we've seen a lot of issues, and this is since the inception of the program, with some of our mechanical and HVAC projects, specifically ones that are high efficiency electrification projects. So Vijay, I'll pass it to you here for a second to talk through some of these.
Sure. Thanks, Elise. Hello, everyone. So yeah, the fundamental concern or issue that's been brought up numerous times as over the last few years is the fact that mechanical upgrades to high efficiency heat pumps and high efficiency chillers and other HVAC projects have not passed SAR. So several contractors have basically not been bringing those projects in because they don't expect that they're able to pass SAR, and the ones that have come in, and we have a couple of examples that'll come up next, have not been able to pass SAR without some sort of extravagant or increased incentive from the utilities based on special programs, but otherwise they haven't, unless they have solar projects or lighting measures to help pay for some of the HVAC upgrades. So the concern is that projects that have included, switching from oil-fired boilers or fossil fuel heating to high-efficiency heat pumps have not passed SIR because just simply the energy cost savings over the life of the projects don't exceed the investment, even though the property owners seem excited about doing them for numerous reasons. One of which is cost savings, but there are other reasons they'd like to move forward with these projects. Energize Connecticut uses a different approach. They use incremental cost instead of total cost, and the way they do their calculations is kind of different on the incentive side. So contractors have also tried to figure out how do we kind of combine, how do we participate in both programs, or how do we go to a customer with the intent of participating with CPACE as well as the incentive programs, and how do we kind of marry these programs together? So the intent of our solution was to try to identify what is the best way to promote electrification, be able to finance electrification projects, and so that's kind of where the solution came up.
Yeah, and exactly, and just to kind of put a bow on that, it's really about making it easy. I know we talked a little, almost a year ago now, about the new construction guidelines, and that's kind of what we've been leaning towards with a lot of these, a lot of the aspects of our program is how are we going to make it easy and accessible for borrowers, for contractors, for capital providers to use it. And in this case, because of the hurdle that just really didn't seem to work for some of these, seemingly good projects, electrification projects that the borrowers are excited about doing, without having that positive SIR. So really just focusing on this cash flows and not kind of the other positive aspects of the project, as Vijay said. Sometimes they fall by the wayside. Or they end up putting in just basic equipment, which we don't want to see, right? We don't want to see them replace things. We want to see them replace things with high efficient alternatives. Okay, and then these are a couple of examples. So I won't go through them in super detail here, but the first two up at the top, the West Lane Inn and the Tabernacle Church, these are projects that both had VRF heat pumps, which is variable, I forget what the R stands for, something frequency. I can never remember that acronym, but electric heat pumps, and they were both replacing fossil fuel heating. The first one, the West Lane Inn, you can see that we didn't end up financing the entire amount. Even with an Eversource incentive, which was kind of a standard incentive, it wasn't enough to get us to a 100% financed amount. In this case, the borrowers were really excited about doing the project, so they went ahead anyway, but we were only able to finance, as you can see, a portion of what they were looking for. And then the Tabernacle Church, this is one we just closed actually a few months ago. And in this case, you can see the significant incentive there, the almost $112,000. And this project was only about $160,000 to begin with. So this was a special early retirement incentive that the utilities were running. If they didn't get that incentive, we would not have passed SIR. So we did only end up financing just under $50,000. But again, that's, about a third of what the project cost was, and it would not have penciled without that. And then the last example there at the bottom, that's just one that we didn't finance, which we've anecdotally heard of a bunch from contractors coming in, but of course we don't know what we don't know, so I'm sure there's many more that just haven't come to us. But in this case, this was a very large, higher than code chiller that the Greenwich YMCA was looking to install. There was no utility incentive, but we ended up with an SIR of 0.35, which is pretty low. So we really didn't have Vijay was talking about having the ability to add in some additional measures to make that SIR kind of bump up a little bit. And in this case, we really couldn't do that. So despite the property owner being really excited about doing this high efficiency chiller project, the project did not did not proceed because they could not secure financing. So this is the policy, the SIR policy revision suggestion. So we would like to continue to require the SIR calculation, but remove the necessity for the SIR to be greater than 1 for technologies identified as high efficiency electrification technologies with no fossil fuels. So we put a couple of examples of those down below. Heat pumps, heat pump water heaters. A lot of those things are probably familiar to you all, just kind of in hearing about them, but things that are meeting the state goals as well. And then next slide, thank you. Yeah, and so just to kind of, it's a big change, right? The not having an SIR or not having a positive SIR requirement for energy measures is a big change for us, as Mackie said. But really what we're going to continue to require, all of the points here on the left, we'll continue to require the energy audit. We'll continue to require the actual SIR calculation. DNV and our partners that do the technical reviews will continue to do those reviews. And as a capital provider, the Green Bank will continue to use all of the same underwriting criteria that we do now. So the loan and the lien to value calculations will still remain the same. Our debt service coverage ratio will still remain the same. So the way that we look at these projects financially will be the same. Meaning that regardless of kind of what that energy savings looks like, we still want that to pencil out with our financial underwriting. And then all of the other CPACE programmatic requirements will continue to remain, including the lender consent piece of it, which I want to just talk about for a second. One of the other statutory requirements of the program is that if there's an existing mortgage holder on the property, they're required to consent to subordinate CPACE because CPACE is a senior assessment. So just wanted to point out that the mortgage holder always has the option to say, no, I don't want to subordinate to this project. It doesn't look like it's cash flow positive. I'm not comfortable with that. So that option still remains for the lender. But the new requirement that we're thinking about, we haven't fully put this into stone yet, but one of the new requirements that we're looking to add in for these projects is to require the borrower to review the SIR calculation and sign a document or something stating that they understand that this project is not going to have a positive SIR. So understanding that they may not have that positive cash flow over that term. So again, eyes wide open, going in for whatever reasons make sense for their business. And here are some of the benefits and challenges. I think I've talked through a lot of these, but some of the benefits. So of course, incentivizing property owners to explore electrification measures now that they know they can finance them with us. This goes for the contractors as well, having the contractors know that this is an option. They'll be able to include that in their conversations with their possible clients, excuse me. More electrification projects in the state, of course, aligning with our greenhouse gas emission reducing policies. And again, other aspects, making decisions based on other positive project aspects besides cash flow. And of course, hopefully that means more projects. If we have a bigger pool of projects that we can finance, hopefully that means we'll close more. Some of the challenges, we just talked about the lender consent piece. They may not be comfortable without a positive cash flow. The savings from the project won't be greater, of course. So there is a little bit of a risk of default. And I'll talk about that too in a second. We've got a little bit of anecdotal data for you guys. And then financial underwriting won't have that added benefit of the positive cash flow. And then lastly here is that extra step potentially to have a property owner sign a document or something stating that they've reviewed these cash flow analyses and that they understand how their project is projected to perform. And then I guess quickly, and Mackie can chime in here too. We did ask around just in around the default question, and kind of as we've been working in the industry now for 8 or 9 or 10 years, we really haven't heard a lot of CPACE defaults or defaults based on non-CPACE payments on the commercial side. We've heard a lot, I'm sure you've all heard a lot in the news of some of the residential issues that have been going on, but not really on the commercial side. And that turned out to be true. We polled a lot of the other admins in other jurisdictions. Also asked PACE Nation, which is the leading PACE organization in the U.S. And really, there've only been a few, and most of them have not been specifically because of PACE non-payment. It's usually because there was a mortgage situation, and a lot of them have been resolved. So we're talking a handful of hundreds and hundreds of PACE commercial PACE projects across the country. And some of those jurisdictions do not have an SIR requirement at all. So we've seen it's a pretty good track record. I don't know if you want to add anything to that, Mackie, but
no, yeah, I mean, I think that what we are, there's a spectrum of CPACE programs around the country in terms of one of this key feature of CPACE, which is the SIR requirement. I think we're kind of on the conservative side, not all the way, not far right in terms of, we have one. It brings a lot of positive aspects to a program, but there are a lot of programs out there and a lot of folks in the industry that view them as negatively. And in fact, the PACE Alliance, which is the industry group for CPACE capital providers, they've got a paper they put out on the ideal characteristics of a PACE program, and they recommend not having an SIR. I think that's maybe a little too conservative with this, but I don't think that's the way to go. I think they bring positive things to the table, but in some cases they can, as we did in these exact instances here, they can prevent what, at least from my perspective, from a policy perspective, are good projects. And as long as the borrower understands the trade-offs and what they're walking into, from an administrator perspective, I think these are projects that we want to see happen, and make sure CPACE is a tool to help them, borrowers or property owners, achieve these goals. So I'll turn it back to Elise in case there's anything else, and if not, we can turn it over to questions. Oh, there we go.
Yep,
Questions
that's
or
it.
discussion?
Okay, so that was a lot to take in. Are there any questions or observations?
This is John Harity.
Hey, John.
I just think that this is makes a whole lot of sense. I mean, we've got to get heat pumps more widely distributed, and the cost is large. But if people are willing to do that because of the other attributes, mainly cutting down on carbon, then that should be encouraged, and that to me is part of our mission as a green bank, or our primary mission is to help finance ways to get rid of carbon. So I think it makes absolute sense, and I hope that we can adopt it.
Anybody else? Matt Ranelli?
Hi, Lonnie.
Hi.
Yes, yeah, I agree with John about the goal, but I don't think this is the right tool for this, or at least not without a lot more information. CPACE is a brand for us. I don't know if we've talked to our lending partners or downstream, buyers of our these funds, but they've relied on the SIR. We've, I think, established it. It's kind of a sort of part of the brand. So I'm very loath to change it. I also think it makes sense optically in terms of how our program is perceived. If building owners are upside down on projects, even though they sign the statement and feel good about it, they're not going to possibly feel good about it 5 years from now when they sell the building and people are complaining how it was a bad deal. So I really think we have to look out for the brand here. And this seems to be sort of a small part of the overall market. So I would think, let's see if I would like to see if we can achieve that goal by some other means to target these this high performance HVAC equipment, like the utility early retirement program, that we can help fund without making a wholesale change to the CPACE program. I mean, let's look at what the sort of total market is for the projects that we can't reach right now, and see if there's a way to do it. And also, I wonder if the private CPACE providers, let them finance some of these if they're willing to get rid of their SIR. I just think it's a better position for them. And finally, I just think we might also be buying more of a problem in terms of getting lender consent on this. In the next memo about the solar program, I mean, we're already seeing lenders, even with the SIR, who in that memo, who just don't want to finance or sign on. So I can only imagine that challenge will be harder. So we might work ourselves into the ability to do it, but then not be able to get lender consent. So I would just say maybe send this to some of the standing committees and let's workshop some ideas of how to target this, what seems like a relatively small area that we can't reach with CPACE.
So how's everybody feeling about this? I mean, this feels like, I think one of the great things about this organization is the willingness of everybody to take in what board members are saying. So Brian Garcia.
Yeah, I think we're taking this feedback on in, but I'll defer to Mackie here in terms of how the team is thinking about this. It sounded like, Matt, you were proposing their SIR removal for non-green bank financed projects, which may, given our brand of SIR and consumer confidence, that maybe that was the differentiation you were drawing there. But let me see what Mackie and Elise thoughts are here.
I think a few of the others of us have our hands up for questions. Can we put some other things on the table first, maybe?
Sure. Who's that? Sarah? Who's that?
This is Vicky. Sorry.
Oh, Vicky.
Yeah.
Yes.
Thank you.
Ask away, Vicky.
I appreciate it. So forgive me for not being a little more dug in here, but so I think what I heard is that you're looking that the requirement is that the total cost of the investment has to be that the payments have to pay back on the total cost of the investment. So it's completely I mean, that doesn't make a lot of sense to me from a program manager perspective over the CNLM funds, the current approach, because what you try to do, you assume people are going to be replacing equipment anyway, right? They're at the stage of replacing equipment. So chances are they're taking out a loan to replace their equipment. And it's the incremental cost of the more efficient technology that you look to buy down the cost of. I mean, that's what we do. Right. And I think you noted that the Energize CT programs just look at the incremental cost of the more efficient technology, because the baseline, it's assumed that they're replacing the equipment with something less efficient. So am I correct? Is that what I heard? All right. I'm not saying it very eloquently, but that's what I heard. Okay. So why not just adopt that same model and that Energize CT that we use, and just make sure that the incremental costs is more than offset by the savings? So that's my first question. And then my other question is, what energy savings are you counting? Because it also matters, like, are you, what's the baseline that you're using? Are you using, a less efficient electric technology? Or because we just made a change to our cost benefit test, and this matters more, I guess, if you're counting incremental savings, where we account for fuel switching in the cost benefit test. So if you're switching from oil to an electric heat pump, and the old requirement was that you would only count the difference between a less efficient a baseline electric heat pump and a more efficient electric heat pump. And now we count the savings between a baseline oil appliance and the more efficient electric heat pump. So those are just two sort of questions or thoughts that I have that I'd love to hear more about after everybody else asks their questions.
Who else? Who else has a question?
I think I might be next. So you say that even though the savings don't exactly pan out under our regular formula, that the borrowers want to go forward with these projects for other reasons. Now, what are those other reasons? They have a desire to be more low carbon, but really going to what Vicky was asking, these systems have to be replaced anyway. I mean, right? I mean, they just need a new system. And so are there other reasons? You talk about other reasons. I just want to better understand the other reasons that borrowers would want to go forward even if it didn't meet the SIR, or didn't really pan out on a savings basis under the formula. But I think Vicky hit on a lot of it. They just need a new system anyway, right? And this is what do they use to replace it with? That was my question.
Elise, do you want to take any of those, or?
Yeah, sure. I think there's a few. Well, the most, I think, to Vicky and Sarah, your questions, the incremental cost conversation actually was the first iteration of this, and we kind of moved away from it, but we did have that conversation internally of how we could use that in our SIR calculation. It didn't quite line up from what I'm remembering with how we calculate our SIR, and I think it would still require some sort of a change. So I think we moved away from that, and this was kind of our next option.
And I think honestly, we moved away from it because it would weaken. It was actually a sort of a further, more aggressively weakening the SAR, I guess I would say. So if you take the incremental cost approach, your cost would just be the difference between what you have to do. Your point, Vicki, you're installing equipment, you've got to do what code requires you to do. So we don't really need to incentivize that. We're trying to get you to go above that. So what's that cost difference? If that's our cost, then it's basically going to be so small that it renders the SI, because to answer your second question, which comes into play for what's our baseline, unlike the utilities, which use code as the baseline, we look at the actual baseline of the prop. So we look at past usage. If they're oil, we look at the oil cost and estimate what the savings would be from switching over to electricity. So those savings are, in a lot of cases, they are pretty high, or at least higher than the utility number yields. And when you take that approach and only look at the incremental cost, a lot of projects would get through that arguably aren't a lot of, I guess would be just blunt about it, a lot of fossil fuel upgrades would get through that wouldn't have before. So we took, we thought, well, yeah, that is a okay outcome in that we're looking at an equipment replacement. We want to get the best equipment in there as possible. Better and more efficient fossil fuel equipment is better than just code, but we've ultimately got a goal of electrification. So let's design a policy that would really do as much as it can to incent electrification. The incremental cost approach would allow those fossil fuel upgrades to get through in many cases. So that's why we moved towards this.
Can I follow up on that? Thanks. Mm-hmm. So that actually surprises me that you don't use code as your baseline. So thanks for that explanation. So I guess like where I'm coming out is I think it's pretty standard across, energy efficiency program administration to use code as the baseline and incremental cost as, I think the way we do that sort of cost effectiveness is fairly standard. I'm not, I can't 100% speak to that, but I think it is. So I think my suggestion would be to take a look at adopting more of those standard approaches, but I understand that could create, ripple effects. But I think to not have a cost effectiveness test that's sort of based on those standards and to just say for electrification measures, we'll give it a pass. I think that's going to be hard to defend. And I think maybe for good reason. Because I think we have to be able to sort of defend the integrity of the programs and that we are, helping people to achieve upgrades that are more efficient than what they would have had to do anyway, at lower cost. And so I think you have to have a standardized, studied, well accepted way of doing that. We do that within Energize CT. I think it would make sense to take this to one of the committees and think about just have that conversation about cost effectiveness testing. And I'm sorry, I know that's a can of worms. As a program, having a program oversight overseeing a LEM, I really do understand it's a can of worms, but I think it's one that we really do need to talk about. And if we can provide a lot of support on that, the utilities and the Energy Efficiency Board and DEEP, because we spend a lot of time on that, but I do think that that's a conversation that we should have versus having a blanket exception for electrification measures. Because even though, as Matt said, that might be a small number of projects right now, it's not going to continue to be a small number of projects with the IRA incentives coming out. This is the future of our programs. And I think we have to have a sound sort of scientific basis to calculate cost benefit in the programs.
I think just to be clear, we wouldn't allow, if under this new policy, we wouldn't allow code equipment to get through. We would require higher efficiency. We'd have standards in place to make sure that, that is the case. So that's what we would do. We would allow code equipment to get through. We would require higher efficiency. We'd have standards in place to make sure that, that is the case. So that's what we would do. We would allow code equipment to get through. We would require higher efficiency. We'd have standards in place to make sure that yeah, we're getting something additional. And then on the, I mean, we, because of the SIR requirement, we approach, that's why we took that fundamentally a different approach from day one from the utilities, because what we cared about was the actual overall dollar savings that the customer was going to see from the project. So we could, because we cared about can they service the debt based on the savings from the project. So looking at the savings just from code to what they're actually doing, or looking at just the cost would, and then look at the overall. Yeah, so I can. That was the reason of taking that fundamentally different approach. Is we needed to look at the actual revenue from the project, which was forced on us by the SIR. If we take that other approach, then it's really just a fundamentally different approach. And I guess we could look at that, but I just want to be clear that we're not trying to get rid of it to let people do things that, in these cases, that they could do anyway. Quite the opposite. We want to make sure it's a tool to be able to pull people to do something that they might not have the capital to do. And to Director Sanders' point, why would they want to do that when the cash flow isn't there? It is primarily because they have to do it. There's aging equipment. They need to replace it. That's the key area at the time when we can step in. Like, these decisions only happen every 10 to 20 years. So when they're being made, we want to make sure we've got a tool that will do that pulling to get the most efficient equipment in there at this crucial time. So it's like in most of these cases, something's going to happen. The equipment has to be replaced. So it's not being made based purely upon cash flow considerations. So if we can, make the economics more attractive with CPACE than just coming out of pocket or going to a, more traditional financing source, if we can make it more attractive to get the more efficient equipment, that's our goal at this, this sort of crucial time to intervene.
I hear all of that, and I just want to be clear, I'm not questioning the intent at all. I just think that maybe this requires a little more technical discussion and understanding. I think that, we're hearing a lot of questions. I'm also curious how the new IRA incentives might impact the need, because we're getting some new large incentives, and I'd like to see how that impacts the whole cost benefit calculation. And so I just think that this should be a conversation. I'd like to be part of the conversation, and I think it just requires a little more conversation from my perspective.
Okay. Well, why don't we do that? Why don't, sorry.
Lonnie, can I jump in too? I agree with Vicki and Mackie. I wonder, as part of that conversation, I just don't know, maybe there's a way that we bundle the incremental cost into CPACE and use some sort of private financing or existing program for what would have been the baseline cost, or some way to make it work. I mean, we definitely, I agree with whoever said this is going to become a bigger and bigger segment, and we want to get there. I just, I won't repeat my other concerns, but I agree. I think we can maybe work on this. And I also, it may be quicker than going through the legislature also, just to add to that.
Well, why don't we, I just see Director Farrar has her hand up. Why don't we get that input, and then we'll move on. We'll take this input and reach out to have a smaller discussion on this. But Director Farrar?
Or Adrienne?
Yeah, hi.
Hi.
I got a couple of questions from a neophyte. First of all, how low are we ready to go? If we go to less than 1, is there a cutoff point? I saw that in one of the proposals, the 0.35 was not enough. But would 50 have been enough? Would 75 have been enough? So there's a question as to what part of the 1 ratio are we willing to go below? And I think it's important to be pretty specific about that, because otherwise you're going to have your clients saying that there's unequal treatment between them. Also, I'd like to know how many cases we're really talking about. I understand that this is an area of growth, but that kind of projection, I think it's important to look at, because we're also in a period when we have rising interest rates because of the inflationary period that we're in. And that means that the interest rate is going to be rolled up in the reimbursement, obviously. And so perhaps reaching to 1 is going to be difficult anyway because of the impact of interest rates. So I agree that there's probably a number of things we need to look at. I'd like to seriously have a little bit more information about where we think we're going with this in terms of numbers, and what we think would be our cutoff point if we were to go below 1.
This is Lonnie again. These are not only important questions, but there needs to be a comfort level with this big of an adjustment. And, as Matt said, this is one of our best known brands. So should we have a motion to send it to committees for more discussion?
We understand the.
What would it be, Lonnie?
Say again?
Which committees would it be? Who's going to discuss this?
So would it be audit, compliance, and governance, or who would?
I think it could go one of two routes. It could go to audit, compliance, and governance because they handle general kind of like policies within the Green Bank. But I think it equally or almost more could go to the deployment committee because that's the committee that's kind of in charge of, how we seek out projects and financing arrangements and things like that. So I think both could work or either one.
Well, I think I think both is a very good idea.
Okay.
So do we want to have Mackie, did you want to make a motion to send it to those committees for?
Oh, I don't think I can do that.
Okay, who can do that?
That makes sense.
I'll make the motion. I'll make the motion.
Vicky. Okay.
Yep.
So I hear a motion. Do I hear a second? Is that you, Matt?
Yes, it was.
Okay. So all in favor of sending item 6 or resolution 6 to the deployment committee and the audit, compliance, and governance committee for further discussion and resolution. All in favor?
Aye.
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 Opposed? Abstaining? Okay, good. Good. And that's a very good resolution for that.
Madam Chair, this is Binu. I just have a question. Can there be a special committee with members of both committees instead of having 2 meetings discussing the same item? Can we just have a special meeting or a special committee?
That sounds like a good idea. How does everybody feel about that?
Lonnie, I think they can have a joint meeting. They just schedule it at the same time.
Yeah.
That's right.
That's a good idea.
Yeah.
It is a good idea.
Okay. So the chairs of those two
As
committees.
the chair of the deployment committee, I think we can take care of that. Yeah.
Okay, good. All right. Moving on. Let's see.
Me again.
Oh, okay. Go, Mackie.
Great. Thanks, everyone. Next slide. So another exciting update. First time in quite a while, I want to talk through a new product that we'd like to introduce under the guise of our commercial solar program, which has sort of been a long-standing approval or set of authorities that the board has given us to operate in the commercial solar space. It includes providing development capital for projects, which we then sell to IPC or others. Also providing construction financing for those projects, as well as those developed by other developers and system owners. We also provide debt to other third-party owners. So IPC is the most prominent for these, but Skyview, Sunwealth. We also have great partnerships in place to provide debt for the third-party systems that they own. And today we wanted to add a new option to this list, which is to provide debt to individual property owners to purchase solar systems themselves. Clearly, CPACE has been our long-standing and most successful product to do this. and we would continue to have it as our preferred option. But there are many cases where CPACE doesn't work. There's a few most prominent examples of those would be condominiums, associations, where you've got, they technically qualify as a multifamily property, but you've got, I think folks know how condos work. You've actually got individual tax parcels there. You have residential mortgages on there. You just can't get a CPACE assessment on those. And then we've also got a lot of nonprofits that access financing from institutions like CHIFA. So you've got, which is bond backed. So you're just not able to get CPACE consent on those from those bondholders. And then another sort of area where we encounter resistance is with properties that have financing from the U.S. Small Business Administration. 504 loan is a very common product that they use. There's hundreds of those in Connecticut, and they have a longstanding policy of not consent. The SBA will not allow consent for CPACE for those. So there's a pretty wide market, especially condominiums, as Chair Reed knows well from our recent discussions about this space. There's a significant portion of the population of Connecticut that lives in these types of communities, and there's financing is one of many significant barriers they face in going solar. So we've been, this has been a problem for years. If you can go to the next slide, please. And some recent changes in the solar policy in the state gave us, finally offered us a mechanism to address this underserved market. The key issue that we faced is security. CPACE is great because we get a senior tax assessment on the property. It's incredibly secure, so we can offer long-term attractive financing. When you don't have CPACE, what's your security? That's been our issue. The new solar program, the non-residential energy solutions program, which started last year, offered up a new and unique opportunity to give us the security we need to provide attractive financing. It allows assignment of the actual tariff revenue to a third party. So, whereas in the past, if we were contemplating one of these loans, we would have made the loan to the property owner and relied on, they would have seen the energy savings from the project, and they would have made payment to us. So we would have carried that payment risk, and our credit would have been the property or the property owner, and we wouldn't have CPACE as security. Now our counterparty becomes the utility because there's a contract with the utility to purchase the power and the RECs from the system, and in pretty much every case, the utility is going to be a more attractive counterparty from a credit perspective than the property owners that we tend to serve. No offense to them. It's really just the utility is a great credit. So, we are very experienced with understanding. So then our primary risk is the solar system going to produce, right? We've got a counterparty that's definitely going to pay the utility. It's going to purchase the power. So our risk becomes solar production, which we know that incredibly well. The product that we envision is a loan product. So the loan is to a property owner. And again, we would get assigned whatever portion of the revenue we need to service the debt. In terms of how we would sort of the approval structure for these transactions, it would mirror what we have for CPACE. So anything below 500,000, the staff would approve between half a million to 2.5 deployment committee, anything above that to the board. So let me pause there with any questions or comments.
Mackie, it's Matt. This is, I think, great way to sort of find ways to get the IRA money into Connecticut. I especially like the idea of sculpted amortization payments to capture those tax milestones that is listed in the memo. I guess the only caution is, and I know Brian Farnan's working on this, is for that NRES buy all tariff, there's this issue with the property tax. So obviously, I think we want to know before going into any of these projects the tax exempt status of the system.
Yep, absolutely. It's a key issue for every for this as well as all the solar buy-all projects that we look at. So we're working with industry. OPM recently, they had a working group on this, put out a set of recommendations. So yeah, we're working with industry I agree. This just got to be fixed and provide some clarity. The affordable multifamily space, those are all buy-all projects. It's key for that. So, yep.
So any more questions or observations?
This is John Harity.
Hey, John, go
If
ahead.
I might, just for a moment. I just think that it's so important for us to be as aggressive as possible in helping Connecticut business owners and homeowners and other entities to be able to, change over technologies to lower carbon output. I mean, it's just as critical. And so I'm really I really like the idea of us reviewing what we can do in order to expand our markets and to be more aggressive in getting those products out there and getting more participation. Because at the end of the day, in terms of what we're doing, we have to be fiscally responsible, and we've got a whole lot of financial do's and don'ts and lines not to be crossed and whatnot, and I can appreciate all that. But we have just got to continue to address climate change. That is so. So I'm really happy that you all are looking at new and better ways to expand these programs in order to do that. Thanks.
Thank you. Any other observations or? As Mackie was saying, just dealing with the condominium communities, and I've been hearing a lot from them. We bounce around with these issues, those of us on the board and in the various agencies that deal with energy issues, and it confuses us. So you can imagine what it's like when suddenly, these communities, I mean, they know they need to go solar, they need heat pumps, they need to really, and car chargers, they're going crazy for car chargers. How do we do that? And they're looking for guidance. And I agree with John, we need to start to be aggressive and, figuring these things out ourselves, but also sort of helping people through, because it's going to just get faster and bigger. This year, I think is going to be pivotal. So I tend to agree. Do we have a motion to approve Resolution 10?
So moved, John Harity.
Do I hear a second? Who's that?
Second.
Was that Matt?
Yes.
Okay. All in favor?
Aye.
Aye.
Opposed? Opposed? Abstaining? Okay. Excellent.
Thank you. And I want to thank the board, and also want to thank Luis Della Pesca and Peter Ludwig, who really did the hard work on this, developing. We had an opportunity come in we couldn't address with our existing products, so they did all the problem solving, did the work around that project, which led to this innovation here in new products. So all credit due to them, and thank you all for your support.
Thanks, Mackie. Okay. Good luck today on the health issue. Let's see. So we're back at what? Resolution 3? Agenda item 4A. Oh, okay. So this is, I think, Jane, right? Jane Murphy?
I seem to be having problems with my camera today, but can you hear me at least on my microphone?
We can hear you. I can hear you.
Awesome. Thank you very much. I'm bringing an update today that came out of the ACG committee that we had on Tuesday morning. And this is for updating our internal accounting control procedures. These are in place to make sure that the assets of the organization are safeguarded and to ensure disbursements are reviewed and approved by the appropriate levels. Also, they make sure that all of our financial transactions are recorded timely and accurately. Annually, when we have our audits, the auditors do run through our internal control procedures and look for any kind of material weaknesses and updates. So we do have 5 procedures regarding purchasing and accounts payable, consulting and advisory services, credit cards, mobile devices, and fixed assets and depreciation. Next slide, please. The updates that came out of the ACG meeting, what we're doing is throughout all 5 of the procedures, we are changing the position titles so they're more generic to be head of operations, head of finance administration, so that as people's titles change, we don't have to worry about coming back. It keeps the procedures more flexible. That's being done throughout all the procedures. The biggest updates are to the purchasing and accounts payable procedures. I do want to preference this with, we had a couple of recommendations come out from the ACG meeting, and one of those was to have these reviewed by our external auditors. They did opine on that. They had a couple minor changes for, renaming fixed assets to capital assets, and those types of things we will bring to the May meeting instead. But the one substantive update that they did have was for the approval recommendations. The first 2 items have to do with approving invoices while staff is out of the office, and also for having a designee for electronic payments, also while staff is out of the office. And the recommendation coming out of the ACG was that these be delegated by the president and CEO in writing, and that is reflected in the update that we did bring to you today. The other thing that the external auditor did recommend for both of these items is that the designee is a senior member of the accounting team. And we have included that as being our controller or our associate director currently now. So we'll be able to get, with these changes, we'll be able to process items without having to worry about, currently now, I do a lot of things while on cruise ships or in hotels, we're on vacation, and that should free me up to not have to worry about doing this if we have a designation in place. Are there any questions on that? Okay. The last 2 items are really more about an administrative burden. Currently, we require the president and CEO to approve intercompany cash transfers. And that's for money that will not be leaving the organization. It's going to either one legal entity to another or between bank accounts for one reason or another. And since funds are not being sent outside the company, we would like to remove that requirement that the president and CEO has to approve. Also, the last thing that is written in the procedures now that we would like to remove is when the president and CEO is out of the office and delegates his authority to someone to approve all of invoices when he's gone, there is a requirement to have these reapproved by him when he returns. And this is really an administrative burden for something that has already occurred after the fact. So we would like to remove that as well. Any questions? Next slide, please. That brings us to a resolution that the Board of Directors hereby approve the proposed revisions to the internal accounting controls and procedures as presented.
Do I hear a motion to approve Resolution 3?
Motion to approve, Adrian speaking.
Oh, thank you, Adrian. Do I hear a second?
Second, John Harity.
Thank you, John. All in favor?
Aye.
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 Opposed? Abstaining? Okay, good.
Great, thank you.
Thank you, Jane. Moving on. Okay, I need the next item, I think, is Eric Schrago, budget operations and compensation. Eric, are you there?
I'm here. Thank you, Madam Chair. So the Budget Operations and Compensation Committee met earlier this month for their mid-year review of targets and budget, and we have a couple of revisions that we'd like to bring to the full board at this point. First, I'll start with incentive programs targets. Here we our proposal is to change the methodology that we have of when we count something towards our targets. Previously, we were basing our targets on projects that we thought would be completed. Here we're proposing to do our targets around projects that have been approved or closed. For this program, approval equals closure, which is a little bit different than our financing programs. Doing it this way is in line with what we have previously done for every other program in terms of counting towards targets when something reaches the closed status. And our big reason for doing this is we lose our control and our influence once we approve something. The interconnection is out of our hands. Getting that constructed and energized is out of our hands. We still have insight around it. We will still be transparent and make sure that there is visibility to the board around what has been approved but not closed. But for our targets, I think if we want to measure really where we're spending time and our efforts and what we can influence, it's really around project closure. So taking that into account, we have a slight decrease in the number of projects, about 10%, from going from 1460 to 1340. We have an increase in capital deployment, and that is due to our expectation that we're going to have a large number of commercial storage projects approved this year. So that brings forward that. And then the increase in capacity installed is also due to these commercial projects. Those commercial projects tend to be much larger than the residential projects. Hence the final two metrics go up, but we do go down. And that is reflective in terms of the overall number of projects. And that's reflective of just kind of the slower uptake that we've had thus far in residential storage projects. Any questions on this before I move on? All right, next slide. So over on the financing programs, we're not changing any of these targets. We do have a secondary target that I want to highlight and clarify, and we kind of fell victim to our own complexity and have cleared that up. But what I really want to clarify is the amount of green bank capital that we intend to use and invest for the rest of the year. And this is different than capital deployment. Capital deployment is really the size of the economy project cost that we're enabling. When we say green bank money invested, which is what I want to clarify here, that's really how much of our capital we are going to commit this year. We have a third number that's also in the budget, which is the actual capital that goes out the door. So what we're clarifying here is the amount of our capital that we're going to commit. As we know, like, projects close, but then it does take a while for money to be drawn, especially in the state of supply chain delays. People may be sitting on that project approval while they wait for things to come in. So this target was previously stated as 37.4 million, which would be great if we could commit to 37.4 million, but the more realistic number is 13.42. So just wanted to clarify that for the board. Any questions on targets before we move to budget? Hearing none, let's move to the next slide. So in terms of changes, we're really bringing the revenues in line with reality. So we are revising the utility customer assessments up because we received more money from the system benefit charge than we had previously forecast. That's increasing by $328,000. We're adjusting down the Reggie auction proceeds. The Reggie auctions have been doing great, but there's a statutory cap to how much we can receive. So we are doing as the statute says and adjusting our budget to meet that cap that we've hit. Those excess funds will be used towards the cheaper program, I believe. So let's go over to deep. Questions on revenues? All right, let's go to expenses. So here we have, in terms of, I'll start at the top and work down. Our top adjustments in terms of compensation and benefits, this is recognizing that we have added one staff member on the financing teams in a part-time role. This is offset down below in terms of a change to consulting fees. So we had somebody who had previously been consulting that has now joined us full-time. This is a great strategic move for the team, and really, I think, allows us to maintain continuity on some very specialized projects. In terms of program development and administration, this is really due to the implementation of Salesforce across the organization, and just making sure that we're further expanding that out, getting everybody up and using it. There's some design changes that we need to do. We need to finish out or hammer out some of the kinks that we've discovered as we got energy storage solutions up and running. So that's the primary draw. And more people equals more licenses, hence the added cost. Moving on to EM&V down below, there are two adjustments within this, one on the financing program side and one on the incentive program side. There's $25,000 in here for a piece of work that we've been doing for a couple of years that I'm really excited about, in terms of us being able to measure the impact of CPACE in terms of savings for our clients. So we've been working with Recurve Analytics on that. And then the other piece is for the an impact study for the RSIP that we have issued our biannual report to the legislature, and now we're going to follow that up with an independent impact report. We're working with a group called Slipstream on that. Moving down to F, which is research and development. This is a large line item, but most of this is due to the hydrogen task force in terms of $315,000. Other proposed changes to the research and development include battery end of life study that we needed to do, and then front of the meter deployment that we've been required to do by PURA. And then finally, a couple items under environmental infrastructure, so including $26,000 for just further rollout of the expanded scope. You'll see the next item on here is $45,000. That's the offset consulting fees that I mentioned previously. I want to highlight two other numbers on here, which are further down in terms of incentives and bringing those in line. Both of those are in the incentives programs. So we have about 4.8 million that we are revising down the incentives that we intend to pay, and that's basically due to holdbacks to third parties who have not yet upgraded their meters. And then we have a change of about 772,000 in terms of battery incentives, which is just representative of slower growth in the residential space. Questions on any of this? I know I went relatively quickly.
Okay.
All right. Well, with that,
No questions or observations?
overall, it's a fairly, our bottom line is increasing about $3 million. So it's a net positive to the budget for what we're proposing. With that, if there are no questions or concerns, I'll talk about the Dream Big option on the budget. And Brian, I don't know if you want to jump in here with me, but I'll give an overview of the Dream Big activities that we've undergone as staff, and then kind of what we're also proposing to the budget as a result of those. So going back to the previous discussion about how do we really lean into the activity in the market that's being spurred by the Inflation Reduction Act, things that are in the bipartisan infrastructure legislation, and then new things that we're hearing may come out of the Farm Bill. We want to see how we can really leverage those to achieve an even greater level of deployment. And so we've had staff working groups focused around 5 areas. And what do we need to do in terms of these 5 areas to really seize this opportunity? So we've looked at our products, we've looked at policy that's adjacent to these products, we've looked at how we promote ourselves and our products, we've looked at our staff, and we've looked at our place and how we meet people where they are. And as a result of these, we've started to hone ideas of things that we need to do. And at this point, when we're looking at budget, we're proposing a couple of additional changes to the budget, which were not included in the slides that you previously saw. So we're proposing an addition of 5 additional staff members that we'd like to onboard over the second half of this fiscal year, so over the next 6 months. 3 of those would be in the financing programs, 1 would be dedicated to homeowner outreach, and 1 would be data-driven marketing. It will take us a while to identify the people, especially in this labor market, and to onboard them. The cost for this fiscal year for these positions would be about $250,000. Additionally, we're proposing $50,000 to help develop marketing assets. So really, how do we show how our financing can couple with the incentives that are out in the market and make sure that that message gets presented in a consolidated fashion to the consumer? We want to make this as easy as possible on people. And the final item is $50,000 for holding Green Bank events, kind of the place item that I mentioned above, of really bringing the Green Bank to people. And this is an evolving idea, but the idea is pop-ups directly in communities supporting outreach efforts, holding Green Bank office hours in areas of high need and high interest to really kind of help people get over the line in terms of doing projects. And there will be more to come out of these big dream initiatives or big dream working groups that I'm sure will be brought to the board further down the road. Next slide. And then this is a slight administrative item that I wanted to just make sure that I brought and raised. When we previously sought approval for doing all of our strategic partners PSA amendments that we do annually, we did last summer. The way that our resolution was written, we did not clarify that Inclusive Prosperity Capital did not have an RFP done for them as everyone else did. And the reason that we didn't do an RFP for Inclusive Prosperity Capital was that they spun out of the Green Bank, and this is a result of the long-term contract with them. And so I just wanted to clarify that so that everybody's aware, so that we can go ahead and extend the existing agreements. Next slide. Well, before I get to the resolution, are there any questions or concerns on any of this?
So this is Vicki. Thank you for this, Eric. I think this reflects, a lot of the work that you're doing, a lot of the work that we're doing over at DEEP to prepare for IRA incentives. I just want to be sure that when you're talking about doing events and things like that, and we'll be doing some of that same work, that sort of developing that public-facing material and promotional material about the new incentives and the all of the business opportunity that's out there. as a result of this and the opportunity for residents to save money, that we're coordinating and that, you know, we're
Absolutely.
speaking with one voice. Yeah. And so I do want to just let the board know about, you know, we are doing that coordination now. We're setting up what I think Brian called brainstorming events with us and the utilities and you all and others. And that it's really going to be important to brand this as like, here's what's available to you for all of our programs across the board, because that's the opportunity that the IRA in particular brings to the table. It's the opportunity to knit all of our programs together into a comprehensive package of programs that our customers can understand all together. So I just really want to emphasize that we are doing that work and that it's necessary to really do that work.
Totally agree. Other questions or concerns?
Do I hear a motion to approve resolution 4?
This is Matt, so moved.
Thank you. Do I hear a second?
Second, John Harity.
Thank you, John. All in favor?
Aye.
Aye.
Opposed? Abstaining? Excellent. Thank you, Eric.
Thank you.
Okay, let's see, moving on. I think Brian Garcia, we're going to talk about revisions to the comprehensive plan.
That's right. So
Okay.
thank you for that. Their revisions to the budget and targets, and associated with that are the red line revisions to the comprehensive plan. So we do this, you know, twice a year, in June and January. So within the materials were included red line edits of the current comprehensive plan to be consistent with what we just voted on. So there are some non-substantive edits. You'll see them all, page number sorts of things, footnotes, links, acronyms, additional acronyms. We didn't have the IRA last time, so we added those sorts of things. There were also some substantive edits. I wouldn't call them big edits, but just things that I wanted to point out. So the executive summary, you might recall last time that it was a cautious executive summary. Now that we've got the Inflation Reduction Act, it's a bit more positive, looking out into the future and in alignment with, you know, the Dream Big strategy, that this is a once in a generation opportunity. So you'll see that tone shift in the executive summary. There are some updates. You know, we updated the residential solar investment program by 6 months worth of data. The targets and budget, which we just talked about and approved, will be revised in this plan. And then on the environmental infrastructure, we talked about it in December. A couple of things are going on. Deep right now is working on some studies around waste and recycling as they look ahead at the future of waste and recycling in Connecticut. So we didn't want to get ahead of that process with regards to our outreach to stakeholders. We'll sit behind, wait for DEEP, support DEEP as they work through that. Then we'll come back next fiscal year and take a look at pulling together one of those primers. So rather than have the primer on waste and recycling done this fiscal year, we'll focus in on it next fiscal year. This also gives us time to focus our efforts on the Greenhouse Gas Reduction Fund and raising proceeds there for Connecticut. And then within the research and development sections, we did include battery recycling. We're taking a look at that as the co-administrator of energy storage solutions. We want to make sure that we're looking at the full life cycle of these technologies. We need to start doing more of that across the board on these technologies, and certainly with batteries. So we included that. So yeah, that was it. Just kind of really pulling the comprehensive plan, updating it, bringing it in alignment with today, and the changes that were just reviewed and approved.
Okay, so do we have any questions or observations, concerns? Do I hear a motion to approve resolution 5?
This is Binu. So moved.
Thank you, Banu. Do we hear a second?
Second, Adrian.
Thank you, Adrian. All in favor?
Aye.
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 Opposed? Thank you, John. Opposed? Abstaining?
This is Vicky. I'm going to abstain here.
Okay, Vicky's abstaining. Okay. Moving on. Let's see. Now, where does that put us? 5A. Is this Bert?
This is Bert.
Okay.
That would be me. Good morning, Madam Chair. Can you hear me?
Yes, yes.
Great. I was having some audio issues earlier today. Okay. So good morning to the board. This is a transaction, the Posigen transaction. This is a transaction that the board approved in December. This is under our Capital Solutions program, a $6 million 2-year senior secured facility to bridge payments from tax equity as well as tax credit adders. When Brian and I were working through the transaction with our counsel, Wigan and Dana, they are our counsel for all Posigen transactions. They determined that the resolution that was approved, which you see down below on this slide, was not strictly in line with the final agreed structure. So the recommendation from Wigan, which obviously staff agrees with, is that we bring it back to this transaction back to the board to modify the resolution to be strictly in line and very clear on the structure. So the structure, as it was presented in the memorandum, as further clarified by what was circulated to the board more recently, has not changed. But we want to make sure that the resolutions line up with that. So for the record, it's clear as we see here on the screen. So if necessary, we'll read it out, but it should be clear there. The issue came in with the wording of first lien, and legally that has a very specific meaning in terms of where you have collateral structures and such. So there is, Brian can elaborate, but there is not going to be, there will be a lien on a bank account that is blocked for us. Is that correct, Brian?
Yes, that is correct.
And so that's the nature of the lien, but this is working through the existing structure that we have for our subordinated loans that are within the Forbright first lien and second lien credit position. So that overall structure, and what we've done is we've carved out a path from the tax equity contribution that is going to be coming in at the project company level, which is typical. It's the same as it works for all the Posigen transactions. And what we have done, as was explained in the memoranda, is we're carving a path into that collections account that will be strictly Green Bank funds to repay the bridge loan. So no one else will have a hand on that cash. So that's the nature of the structure. These are the red line changes you see on the slide is what's on the next slide in clean form. So I would appreciate a resolution that the resolutions be passed. Thank you.
Okay. Questions, concerns, observations? Okay, do I hear a motion to pass resolution 6?
This is Matt, so moved.
Thank you, Matt. Do I hear a second?
This is Dominic, second.
Thank you, Dominic. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Thank you. Let's see, moving on. EV carbon credits. Is that Eric?
Actually, I think we're going to do Cargill Falls. We're requesting an investment modification, and Mariana Treef is going to handle that presentation, and I'll be on the sidelines here.
Okay. Go, Mariana.
Good morning, everybody. This is Mariana Treef. And so before starting the actual presentation, I wanted to share this picture because it has a funny story behind it. So around October or November, FERC did an inspection of the site, and everything sort of looked well. They sent out a letter with a few items that needed to be taken care of, and one of those, it was nothing major. One of those was sort of some debris that needed to be picked up and some weeds that needed to be taken care of on like the side of, I guess, where the water comes in. And our contractors at the site didn't have, it requires some specialized weed whacker equipment to get rid of those weeds. They didn't have that equipment, but they were able to find out that the town of Putnam, had that equipment and worked out a little bit of a quid pro quo with them, that the town would get rid of the weeds and they would help them set up the reindeers and Santa Claus that you see here in return, sort of as a thank you. So I thought that was good problem solving, creative problem solving from our team there that's been working on getting the hydro up and running, and just wanted to share that, I guess, a little bit of holiday magic with you guys from our Cargill site. So going to the, I guess, the project and what we're requesting here, as I'm sure many of you remembered, we've come to the board with this one a few times. This is a mill redevelopment of mixed use residential and commercial, and some of those residential units are restricted for low income because they've received funding from DOH. The mill is redeveloped, had 2 hydroelectric turbines that were sort of redeveloped as part of this project, and that we financed through a CPACE loan, which has financed both sort of the 2 hydroelectric turbines along with some energy conservation measures. From a real estate perspective, the project is doing well. Residential occupancy is at 100%. Vacancy rates are around 6%, which are sort of in line with industry, and it's usually vacancies are sort of the amount of time it takes from one person that doesn't renew their lease to somebody else to come in. There's 45 people in the wait list, and rental income is sort of aligned with projections at around $1.4 million annually. Commercial leases have been a little bit slower to pick up because of COVID. Most of the smaller office and storage spaces have been leased. And so over the past 3 years, the project sort of became operational in 2021 from a real estate perspective. They've been able to get a few tenants and projected to have about $110,000 in leases in 2024. There is one large space that's would have been meant for like a restaurant or something along those lines, which has not been able to be leased up, and which could provide a significant amount of revenue to the property. In December of last year, there was a lead concern in a unit. That unit's been tested by NDDH, and NDDH has gone in and done inspections and testing of additional units where young children reside under the age of 6. They required an abatement plan for that first unit that was tested, and that abatement plan has been completed, presented to NDDH, and I think it was either this morning or yesterday afternoon they approved the abatement plan. So the property manager is working to get quotes to complete the work. the property has not received yet the results of the inspections for the other units that have been tested. And sort of in parallel to that, ownership is doing a more sort of comprehensive plan to test and, if needed, do abatement remediation of the sort of entire property following guidelines from an environmental consultant. On the hydro side, there have been delays, particular to the work that needed to be done with approval from the Department of Transportation and the permit. Once that DOT permit was approved, which it was approved in early fall last year, there were just difficulties in obtaining equipment. Difficulties in obtaining subcontractors and labor to actually finish the work. And so the work was delayed by about another month and a half, completing in late October versus August, which was what we had originally anticipated. And on the other hand, we have had difficulties in obtaining equipment breakdown insurance, but we're able to finally bind that policy earlier this week. The reason being that there was sort of cohabitational exposure, which some insurers didn't want to be involved with. Folks were on site yesterday and we're beginning to test one of the turbines, turbine 2, which is the larger turbine, and the smaller turbine will be tested within the next 2 weeks. There's some additional sensors that needed to be installed. These sort of delays associated with the hydro have had an important, significant impact to the operating revenue of the company and of the property, because the hydro generates about 130,000 in energy savings, 270,000 in ZREC revenue, and around 60,000 in excess generation sold to the grid. So this was all sort of lost income or savings that were not realized in 2023 as had originally been anticipated. If you go to the next slide. So the reason we're coming to the board today is to request a payment modification. Basically what we're asking to do is that 80% of the payments associated with the first lien, which is a larger lien, for the payments for 2023 and 2024 for that first lien be added to the second lien, and extending that term of the second lien from 10 to 15 years. This therefore gives the property sort of some breathing room to allow the hydro to commence operations, to get that revenue in, and also to potentially lead up some, provide some sort of cash flow to address some of the lead concerns that are sort of affecting the property right now. Let me stop there. Before I go into questions, Bert, is there anything you want to add?
Nope, you covered it. Thank you. Well, I will say this, and let me come on the screen. The only thing I want to say is that first of all, we're the only lender other than the contractor we're the Haynes company, without whose support this project wouldn't have been completed. It would have been stopped dead in its tracks. Haynes was extended into this project for several millions of dollars on the faith that there would be a resolution to all the many complex problems, because the owner is, as the board has been made aware over several years, is thinly capitalized. That's the situation that this project has, and nothing, unfortunately, is going to change that. But because of Haynes Company providing the capital through the construction period, taking significant exposure above and beyond what any usual contractor will take, this project was completed. So there, the agreement that we arrived at back in 2021 with the agreement of Department of Housing was that we would clear in return for us coming in, DOH coming in, Haynes would allow their balance to be paid first until I think they get cleared out, and by the end of 2024, is it, Mariana?
That's right.
Okay, and so that is the only other debt that is outstanding on this project, other than Green Bank, as well as DOH. But DOH is out there many years and 30 years out
30
there.
years.
So we're entitled to all the cash flow after expenses. There is no other pot of money here to deal with. There are no other assets of the project to deal with. We have all of the assets. So this is not a preferred position, but it is unfortunately where we are. If we allow the facility to go into default, we're literally just going to be playing around with ourselves in terms of the town charging 1.5% per month on any past dues, and then we'll have to end up restructuring that, and there literally is no more money. So it is better, we think, to restructure in a way that we see a path forward. And since we get all residual cash flow after expenses to pay down our debt, we think this is a sensible approach. So not where we want to be, but we're making the best of the situation. And fortunately, hydro will be kicking on in the next several days, as Mariana explained, reducing the amount that has to be paid out to Eversource, which will improve the cash flow of this project, and more clean energy, as we had all had the vision for many years ago. And so we're happy to take any questions from the board.
Hi, this is John Harity. I'm just wondering, do you think this is the last of the tweaking or whatever that we'll be doing with this? Because there's been a series of it. I think it's a great project, but it just seems as though we've ended up, having to modify a lot of different stuff, over a lot of different meetings. Is this the end of it, or what do you think?
We hope so, John. We're frustrated by it. We almost consider this to be one our whack-a-mole project. We knock out most of the issues, and then out of the blue, this lead exposure issue arose, which by the way, I think, Mariana, it's like 70% of multifamily properties throughout Connecticut have lead. And so it's a matter of these are statistics we can get to you from the Department of Health, but these are just issues that just need to be managed and dealt with. Whether this will be the last one, John, I certainly hope so. We do have a good property manager in the Conover company. It's fully leased up. Obviously, the residents on site are concerned about the lead, but I think it's more from a position of being stirred up by legal counsel.
Yeah.
That's just the nature of the beast.
Yeah.
So we're working very well with NDDH, as Mariana explained. We're doing all the things we should do. In fact, we're going above and beyond. And we're going to make sure that that's handled. So, and DOH is also concerned as well, as you can imagine. So we hope this is it. We see a path. We see a path forward, and we're just going to be happy when those turbines start start turning.
Any more questions or comments or concerns?
Lonnie, this is Matt. I'll try to be brief. I've sent Bert and others some concern. I have concerns, and it is a great project. In some ways, it was an emblematic project because it was an opportunity to show how we could take a really difficult site and work in hydro, which we don't have a lot of project experience with, when, redo a mill and, all these great upsides. But it's also become an emblematic project in a negative way because, honestly, I just don't feel like we've had a good partner on the other side. Based on what I know there were some very extenuating circumstances early on, but we've been back again and again, and I'm just concerned. So rather than tick through all of my concerns, I guess the first question I have is, how urgent is it that we act on this? Because I feel like we would benefit from knowing a few additional things, such as what is the true extent of the lead issue. I mean, we know what it is for the one unit, and my understanding from the memo is there's additional testing that was done and is pending, and probably additional investigation beyond that testing. So it seems premature, unless we have a deadline, to make a decision without knowing the scope of that issue, which can be a pretty big issue, and which also I assume we paid an abatement contractor to abate the lead when this whole facility was redone. So what's the source of the lead is also, I think, a question, and whether it was existing or brought in through a contractor during the renovation. Those are important questions. And then on the SIR part of this, I guess my question is, I think it would be helpful to have the SIR and to know what the cash flow position is with regard to the RECs. Have we lost sort of irrecoverably some of the years of the 15-year term of the RECs? And will that impact, is that already factored into the staff's evaluation of this? Again, Bert and team, I know the amount of work. I mean, as you said, not only have you done everything, you've probably done more than everything. But I also think as a board, if we have time, we need to know our options, including what is our position if we try to force a sale by, either foreclosing or threatening to foreclose, so we can get an owner on the other side. And maybe I'm being unfair, but from my point of view, an owner that maybe is better capitalized and doesn't have to rely on the green bank when this happens. I don't want the project to fail. We've been too far down the road, and I know from Bert's memo and evaluation and the teams that they feel like we're on the cusp of getting the cash flow right, which I truly hope is the case. But I also think it would be good to know these answers if we have time to know them, or do we have, no time and we have to act today?
Okay. There's a lot there. Let me suggest, and I'll deal with this really quickly. We won't get into a discussion if you'll allow on the lead, because that's a matter of potential litigation. So so we really need to park that off to the side, other than what's been presented today, and as well as in the memo, which is in the public record. And I'll ask Mariana to address, after I'm finished, with the SIR matter and with the ZREC matter. Did somebody just? Okay, thank you. So as far as the matter of urgency, in part of my comments, I mentioned that if we don't do anything, it's clear they're not going to be able to make the payment. They're just not going to be able to make the payments in terms of a full payment to us. So the project would go into default. It would then start to attract this 18% add on to what's not paid, which will be, substantial. And then that just gets very complicated, Matt. We really don't want to go down that road. We've had our experience with that on other transactions. We always end up in the same place, trying to restructure, work it out, trying to get rid of that 18% and so forth. So really would appreciate it if we just avoid that whole process. As far as trying to force a sale here, frankly, this property needs to stabilize. So it needs to stabilize with everything working, meaning out beyond the lead situation, hydro working, fully leased up, get a couple of years, and then the project will be in a best position to attract a buyer. That's always been our view. I think we've expressed that view in the past. And so I think to get into forcing a sale right now, we'd really be forcing a sale in really the worst circumstances, high interest rates, lead exposure, which hasn't been fully worked out, hydro having not really demonstrated what value it brings to the property, and such. So I think that we'll be better off if that's done, say 2 years down the road, and a look-see, and we will look at that. And we've got the folks at Conover that can probably help with that, since they're present in a number of other properties. But I'll shift it over to Mariana for a view on the ZREX, which, yes, we are unlimited time frame with that, as well as the requirement for SIR. Thanks, Mariana.
Yeah, so on that note, yes, the clock has been ticking on the ZREX. There were some ZREX that were generated because the project first came online with one of the turbines back in 2017. Project went back offline, I want to say it was in 2019, because as part of the redevelopment, there needed to be bifurcation work to allow the second turbine to come in, and there have been all these delays, which, as John points out, I hope this is the last one. And I think it is. We are really right there. So there has been sort of lost ZREC revenue, and the SIR requirement will be required sort of for final modification. I think, as Bert has mentioned, the reason to bring this to the board now is because payment is due by the end of the month. We don't want them to go into default to add on late payment fees, and restructuring after the first of the month, after January 31st is more challenging. But SIR is a requirement before that modification, and all of these items will be taken into account, and part of in our initial sort of diligence, we think we'll be okay in that matter.
Two quick questions. One is, what's the payment due at the end of the month? Is there any money left we have discretionary where we could make that payment, buy ourselves 6 more months before extending the deadline? And then two, I guess for Bert, it would be great, but I guess my worry is, 2 years from now or 3 years from now, when it's stabilized, we probably won't have, if they're meeting their obligations, I don't know what our leverage would be to force a sale. Is there something we should think about getting now in terms of an assignable right, so we have it, as long as we're making a modification here, to increase our control should this continue to happen? No one wants to be in this situation, and it would be great if we could buy. I don't know how much the payment at the end of the month is, and whether there's some way to make that payment, or any interest in doing that. But I just worry that we don't know the extent of all the problems. And I agree, Bert, about tabling the lead, but it's obviously something we need to know more about eventually.
Sorry, am I on?
You're good.
We as an alternative, Matt, if you want to do so, I would say the only alternative to, say, come back and revisit this, say in at the June board meeting, just before the July payment would be done, would be to just do, Mariana, maybe a deferral of the first lien payment. Is that because I think we have the second lien payment being made, correct?
That is correct. I mean, as part of the modification, the second lien payment, which is an interest-only payment of about $30,000, will be paid. The first payment that's due is about $260,000.
Yeah, and I'll defer to the rest of the, obviously weigh in.
Yeah, the thing is that the alternative would be to just defer this payment, but when we defer this payment, we have to refile the lien because we have to change the lien. So we'll come back and we can change the lien twice. It's just but again, we're entitled to all residual cash flow. So I think, but I take your point. If you want to, we want to seek to negotiate, etc. By ourselves. I can't quibble with the strategy. So we could do that. That's if the rest of the board wants to go with that, just change it to a deferral of this month's payment on the first lien, and then we'll come back to the board in June with an update and further requests as necessary.
How's
This is
everybody
Vicky.
feeling with it?
I would support that. Sorry, go ahead. Yeah, I've been following along, and I agree that I think that might be a good way to go.
And does a deferral, Mrs. Lonnie, does a deferral in any way impact us in a negative way in terms of
No.
or
okay. No. The only thing is we'll have to come back to it. We will have to touch the lien again.
Okay.
But that just means refiling the paperwork. It's not the end of the world. I mean, it's just another detail. So it's fine.
Okay. So do we need a motion to do that, or can we just?
Let's see. Where are they?
Brian, would we need to change the resolution to say?
Yeah, well, the resolution as is doesn't work if that's the new approach.
So Brian, you got one? Mr. Lawyer, you got one? Mr. Lawyer, we're returning to you.
Exactly. Well, at the end of the day, are we taking no action until the next board meeting? If we're taking no action, then we could take the feedback from the board members and no resolution is necessary.
That sounds good.
I thought we were taking a deferral.
We are taking action. So I think
anything that's inconsistent with our existing authorizations.
Yeah, we need authorization to defer any payments under an agreed structure that's been filed. So it would be authorized to, in the second line there, to defer the first lien payment due January 2023. And staff is directed to return to the board in June with an update and to the board in June 2023 with an update and any additional request for modification. Okay. All right. So authorized to defer the first lien payment due January 2023, and staff is directed to return to the board in June 2023 with an update and request for modification if necessary.
Okay, that works.
Good. Okay.
Can we get a motion, please?
Can we get a motion, Matt?
Yes, so moved. Thank you.
Second, it's Vicky.
Thank you, Vicky. Okay, all in favor?
Aye.
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 Opposed?
Aye.
Abstaining? Okay.
All right, thank
Moving
you.
on.
Thank you, board.
Hey, I have one last comment on this, if I could. This
Okay,
is John
John.
Hardy. I'm assuming that you will convey to the parties you're dealing with the growing weariness and the lack of infinite patience of the board with these circumstances.
We will, John.
Thanks.
I'm guessing that you have. Just guessing.
And we will again.
That's good. I think we have one more item to vote on. This will be Eric on the electric vehicle carbon credit pilot program. And then following that, there's going to be some, because I know some people have a hard, quit time that they have to quit. But after that, there'll just be some kind of updates and stuff. But this will be the last item that we'll vote on. And so, Eric, could you talk to us about the carbon credit pilot program?
Thank you, Madam Chair. I will go through this as quickly as I can. So a bit of history. We've been running an EV carbon credit pilot program. So carbon credits are something that we don't do anywhere else in the Green Bank. It's a derivative of the environmental assets or environmental attributes of clean energy projects or other ways to abate carbon emissions. We work to develop a methodology with using the verified carbon standard, which is administered by Vera. We worked with a bunch of partners who are in the electric vehicle space, as well as the Climate Neutral Business Network. We developed this charging methodology prior to my time at the Green Bank and finally got it through and approved with Vera in 2020. We did an initial filing with 13 partners in 2021 for charging activity going back to 2016 through 2020. The Green Bank's role in this, we have two roles. First is the aggregator. So we're basically helping get everybody's data. We facilitate the filings with the registry and we get those credits, and then our intent is to monetize those. We are also the steward of the methodology, so it's our job to make sure that gets updated to consider new emissions factors, new vehicles that come online, so on and so forth. So we got these credits issued in October by Vera. They're sitting in our account there for us and our 13 partners. We've been monitoring the carbon offset markets, and we'd like your permission to monetize these. So what I'm proposing today is a process where the board will authorize staff to use this process to sell these credits. So basically our process is we'll verify the quantity, make sure everybody is situated. That is a little bit more complex than it seems, but it's fairly straightforward. We'll consult the market and obtain at least 3 data points for price. So speak to at least 3 potential counterparties. In this market, there aren't, it's not like the stock market and there's a listed price. We need to actually have conversations with brokers, with buyers, and get some data points. We probably will do multiple transactions as part of this because there are various needs within this consortium of partners. And then we'll review and we'll seek approval internally from the CGB officers, the head of finance, and for myself, the head of operations for these trades. And then we'll memorialize the transaction. These are transactions that we intend to do on an annual basis moving forward as we're filing for activity with the consortium on an annual basis. Right now, the forecasted revenues for this are fairly low for the entire partnership, and including the Green Bank's management fee for this. However, just due to where we see prices headed in carbon markets and then overall volume of activity, this does have the potential to be a significant revenue item for the organization, and is a great learning process as we look at carbon markets as a potential revenue stream as we expand into environmental infrastructure. Any questions? And I apologize for my abbreviated presentation. With that, why don't we move to the resolution? Resolve the board of directors of the Connecticut Green Bank direct staff to sell the credits aggregated as part of this project using the aforementioned process and update the board to this process by 2025. And I forgot to mention the update, which is basically as this continues to grow, we want to make sure that our process fits with this in terms of its size on the balance sheet and just kind of the evolution in carbon markets.
Okay, do you hear a motion to approve resolution 8?
So moved. John Harity.
Thanks, John. A second?
This is Dominic, second.
Thank you, Dominic. Okay, all in favor?
Aye.
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 Opposed?
Aye.
Abstaining?
Awesome.
Abstaining? Okay. All right, that's the last resolution that we're voting on, but we're going to have some updates coming up now. And let's see. Is the first one the ESS update?
Yeah, I think it is.
Sergio,
Yes. Okay, so that's Sergio. Sergio, are you there?
Yes, can you hear me?
Yes.
Good morning, everyone. This is Sergio Carrillo. I'm going to provide a quick summary of what I believe are the 6 most relevant rulings in PURA's final decision issued back in December, late December, in the year 2 review of the energy storage docket. Next slide, please. The first decision has to do with prohibiting participation in forward capacity markets of FCM. And FCM is simply an opportunity for battery owners to generate more revenues for their projects by discharging the battery throughout the day to help the ISO New England address operational issues, again, throughout the day. The risk of forward capacity market participation is that these batteries might not be entirely charged for when we need them, right? If they are participating in the program, they are expected to discharge from 3 to 8, and this might not necessarily be possible because they have discharged throughout the day, let's say. So this was a proposal from the Green Bank. PURA approved it, and to compensate battery owners for the foregone revenue, PURA also approved an increase 50% in the upfront incentive of batteries that would otherwise be participating in forward capacity market, or 50% for residential batteries and 25% for C&I batteries. Overall, I think it's a win-win situation. All developers were very pleased with this outcome. Instead of waiting 10 years to receive payments from the ISO New England, they're getting some percentage upfront, guaranteed, and they were very pleased. So this is a win-win situation. Any questions about this? Next slide, please. The second decision, very important decision, has to do with LMI customers and underserved communities. One of the objectives of the program is to achieve Justice 40, right? Which means 40% of the project, 40% of the benefits and the investments need to be deployed in underserved communities or disadvantaged communities. Based on program enrollment or program applications data, we noticed that the percentage of underserved and low-income applications is under 10%. So we are far behind the 40% target. And to encourage greater adoption in these 2 market segments, we proposed to keep the upfront incentive flat. In other words, not reducing like a declining block structure that is happening there. Thank you, Brian, on the standard level, right? But for underserved communities and low-income customers, we propose to keep those incentives flat for the first 50 megawatts of the program. Pura sided again with us. I think this is a very positive outcome as well. Next slide, Brian. The third very important decision was imposing a cap on the piece of the battery that is eligible to receive an incentive. Not necessarily in the battery itself. A developer can install any size battery. However, not all the capacity of the battery will be eligible to receive the upfront incentive. As you know, this is to address basically what happened with the first 50 megawatts of CNI capacity, where we noticed that just a few customers had just taken or used up all the 50 megawatts available. And what we want to do is to ensure that, or to incent smaller systems that are distributed across the state. I think it would foster the sustained orderly development of a battery storage industry in the state by providing incentives to more customers, more vendors, more contractors, generate more employment, etc. So this is a very positive outcome for the program, and we were very satisfied with this decision as well. Next slide, please. This is one very critical decision that has to do with authorizing active dispatch only projects. As you all know, the project as it was launched required batteries to participate in both passive dispatch and active dispatch events. And this caused some heartburn, I would say, with some developers, very large developers, including Sonova, Tesla, Sunrun, some of the largest developers in our SIP. We noticed they were not participating in the ESS program. And this was probably what was causing the issue, right? The need to participate in passive dispatch. These coupled with the decision from Pura to request or to recommend phase out of the Connected Solutions program will allow customers or companies like Tesla's they don't have any other program, right, with less stringent requirements. The only option will be ESS, and presumably they will join the program soon. It was good to see that right after the decision, it was the last week of December, came out. These three developers, Sonova, Tesla, and Sunrun, reached out to us saying, okay, let's talk. What's going on? What does this mean? So to me, they're seriously considering joining the program, at least Sunrun and Tesla for sure. Sonova might not necessarily join just yet, but this is a great outcome. Again, it will force it provides fewer opportunities for developers, right? There's only one battery storage program in the state. They will have to join. So this is a very, very positive ruling for the program, I would think. Next slide. And this one has to do, this is also very critical. We talked about these probably back in May, June, when we noticed that the CNI capacity, we had run out of capacity in the CNI, the 50 megawatts that was allocated from 2022 to 2024. Back in May, someone asked in a board meeting, so what do we do now? Are we going to have to wait until 2025 to continue to approve projects? And that seemed to have to make very little sense, obviously. So Pura authorized the program administrators to open the next tranche, the 100 megawatts that is allocated for the 2025-2027 time period. They allow us to open it whenever we reach 50 megawatts of approved projects in the first tranche. With today's decision, we are at 46.4 megawatts of approved projects. My expectation is that at some point in February, we will be able to reach 50 megawatts. We will proceed to open up the next 100 megawatt of C&I capacity. This will be very well received by all the business community. Next slide, please. Yeah, and the last decision, the sixth one, has to do with multifamily affordable housing. This is a decision that PURA made in the residential renewable energy solutions program, or the tariff program, the solar tariff program, where they approved the treatment of multifamily affordable housing or the treatment as residential customers. In the battery storage docket, they said, we asked for this confirmation that the definition of multifamily affordable housing and the treatment as residential customers was also applicable to battery storage, to the battery storage docket, to which PURA said, yes, it does. And this has very positive outcomes or consequences to multifamily affordable housing, which now there will be eligible for that underserved community adder, which is twice as much, or 1.5 times that of a standard customer. So they will have access to much greater incentives. And now, as I explained a couple slides before, those incentives would be flat for the first 50 megawatts. So overall, very great outcome. I think the entire docket, I mean, I see very favorably all these decisions. It indicates, or is an indication of PURA's reliance and trust that they have on the Green Bank to help them accelerate deployment of clean energy technologies. So overall, it's a great ruling. So any questions? All right, that's all I have. Thank you.
Good work, Sergio. I know you've been really working so hard on this and really interacting with PURA in a very effective way. So good work.
Appreciate it. Thank you.
Okay, next, we're going to, I guess, Brian Garcia, we're going to talk environmental infrastructure programs, updates and recommendations.
Great. Thank you. Yeah, just really quick, an update on our environmental infrastructure developments. We're making steady progress trying to find our new director of environmental infrastructure. We're in the second to last stage of the process, and I would say that we have several unicorns coming through this process who are very interested in joining the Connecticut Green Bank. Our hope is that by the middle to latter part of February, we have our final in-person interview and hopefully extend an offer to bring one of these individuals on to help lead our efforts, working with Ashley Stewart, our manager of community engagement. Our primers, we're wrapping up several primers. I talked earlier about pushing out to 2024 the waste and recycling primer. We're currently getting final comments on our water primers and our environmental markets primer. The environmental markets primer will be a really useful guide for the board on carbon offsets and ecosystem services. So Eric just gave us a really quick 101 on carbon offsets. This primer does a really good job of taking us from 101 to 301 on ecosystem services and carbon offsets. So our goal is to have those finalized by Earth Day this year. And then lastly, as we work to understand how we can engage people where they are and support local community activity, Ashley Stewart working with Adrian, Brenda, and the Bridgeport Regional Energy Partnership team underneath the DOE Communities LEAP program. We're learning from this. This is very new to us, and it's great to dive in with a community and try to understand how clean energy, what technical assistance is needed, financial assistance is needed, and how to support communities as they grapple with the green economy here. So yeah, I don't know, Adrian, if you had anything you wanted to say here, but just broadly, we're learning, and it's great to be a part of this project with Adrian and Brenda.
Well, this is Adrian speaking. It's been quite a ride, and the ride is far from being finished. So we're learning as we go. We just hired on someone who I hope will be a good element added to our team to really dive into the outreach part. And with Ashley and with one other member of our BREP team, we're looking at defining, what that outreach plan should look like. And so TBD, we'll be following this and spreading out our influence and our information throughout the community.
Oh, thank you. Did we want to move on to, let's see, the hydrogen power study with Sarah Harari?
Thank you, Chair. So over the past 6-7 months, we have been working on hydrogen as we were directed to by the legislature earlier this year. So Special Act 22-8 appointed Brian as the chair of a hydrogen task force. And we wrapped up our efforts around it this past week. And so we wanted to provide a quick update to the board around the hydrogen task force and how it went. So this force, the task force had members that were appointed per the special act from DEEP, PURA, many other of our ex officio agencies. Then there were also appointees representing utilities, the industry, labor, environmental nonprofits, and we were lucky to find a very experienced and robust partner in Strategy and Consulting, who both provided the technical assistance and stakeholder management for us throughout the process. Since the process kicked off in July, we focused on the areas that are in the special act that we were specifically directed to look at. And we looked at what are the different sources of hydrogen, what are the uses of hydrogen, how can we help to partner and develop a hydrogen industry in the state. And as some of you might be aware, there's a lot of interest and attention being paid to hydrogen right now because of some very rich funding opportunities through IIJA and through IRA. And the state is participating in a regional a regional hydrogen hub application that is being led by our colleagues over at DEEP. And so this was really viewed as a complementary project to that effort that they're leading, both for the regional hydrogen hub and also for the comprehensive energy strategy. We got to take a little roadshow as part of the hydrogen task force. We had meetings at Nell Hydrogen out in Wallingford and at several fuel cell companies, including Hyaxium and Fuel Cell Energy. We got to go out to visit the Dominion plant as well and sat in on the Yukon's campus at Stores to see some of the highly technical advanced equipment that's out there. So through that process, if you could switch to the next slide, we were able to develop several recommendations to take to the legislature as directed by the special act. So the report was delivered to the Energy and Technology Committee on the 15th. And I'm happy to dive into the recommendations if anybody has questions, but essentially our next steps here we're working with the committee chairs of the Energy and Technology Committee. We're going to be presenting a concept committee bill for them that includes the recommendations that were generated by the task force. And then we will be making a presentation to the Energy and Technology Committee with support from our task force members. I think it was a long process condensed into a very short amount of time, and it's sort of outside of our traditional role to be running such a robust stakeholder engagement process, but we were quite pleased with the end result, which was that the task force unanimously agreed that the report was final and ready to send to the legislature, and that it was a reasonable representation of the robust discussion that happened throughout the previous 6 months. So, Brian, if you have anything to add that I missed, please let me know.
No, that
or
was
happy to answer any questions about the recommendations.
that was well said. The only thing that I would add is that Sarah was the co-chair right there with me throughout this process and was just incredible in helping move things forward and getting to where we were. So thank you, Sarah, for all of that.
Thanks, Brian.
Hi, this is John Harday. I just want to make one comment on this, which is that I think the whole problem in terms of hydrogen, even green hydrogen, is its relationship to natural gas, and including the pipelines need to continue to have natural gas in them in order to deliver hydrogen if you use the pipeline. And whether or not this represents a step forward, or it represents a way of sustaining natural gas longer than we should be doing, including fracking. So it's a big question, and I know at the roundtable we're having a lot of discussion about it, because it's not in our interest, I think, to keep natural gas going beyond its time. Thanks.
Great point, John. The thing that I would add there is that in the Special Act 22-8, in its outline of 7 areas, it asked us to look at sources and uses, but didn't ask us to look at how you get sources to uses, which is the infrastructure that you're speaking about. So we decided that it was important to look at transportation, storage, and infrastructure as part of the process. And you can really see all the different perspectives from the stakeholders in the report. It's not easy. To your point, John, it's not an easy question. I think there's still things to be determined, still science to play out. But we think that we teed up and reflected all the perspectives that came at that issue there. Yeah.
I think, this is Lonnie, as former chair of the Energy Committee, I think one thing that members of the committee need to be reminded is that to the degree we have to continue to use natural gas, that it's not used in a combustionable format, which is part of the chemistry of it. That helps when you're trying to discuss this stuff with them. Okay, and then did you want to, Brian, was there other business that you wanted to talk about?
Yeah, just wrapping up here real quick. We continue to engage with various federal agencies on Infrastructure Investment and Jobs Act, IRA, various programs that have come through the federal government. So we submitted a concept paper to the DOE through their Grid Innovation Program in collaboration with Hawaii and Puerto Rico. We'll hear about that concept paper in late February of whether or not we'll be invited to submit a full proposal. We've been going through a lot of this over the last year and a half of engagement with the federal government on the IIJA. So we thought we would just create a web page on our website to make public all our different comments and engagement. We felt that it was, we're doing it through the board with the various materials, but we wanted to really open it up for everybody else to see what we've been doing. So we created a web page for this report out. And if you go there, you can see the extensive work that we're tackling, and it does feel like 2023 is going to be when all these requests for proposals start to come out. 2022 felt a lot about public comment, and 2023 feels like it's going to be all about requests for proposals. So we're getting geared up. That's it. Thank you for that.
So does that conclude our agenda? Okay, I don't know how many are still left, but do I hear, Sarah, did you want to say something?
No, just I was going to say goodbye.
Oh, okay, good. No, I just
I
want to
move
make
to adjourn.
But I do have a question. I just want to throw it on for a future agenda. You know, I've been hearing all this stuff about gas in the home, producing at-home pollution. And does that change our stance on funding any gas in the home? I'm just throwing that out there. It's in the paper every day. So maybe
no. I think you're absolutely right. It needs to be discussed, particularly given the rate increases that we're going to have now yet again, because we don't have enough natural gas to drive our generation, right. blah, 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 blah. So you're right. We need to kind of circle back and have a conversation again. Figure out where we are and where we're going and how fast we can get there.
Yep.
Okay, everybody. So I heard one motion to adjourn. Do I hear a second?
You hear a second from Adrian.
Thank you, Adrian. Okay, all in favor?
Aye.
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 Anybody opposed? Anybody desperate to hang out? Okay. Bye, everybody. Happy New Year.
Happy New Year.